Hello traders, you're welcome back to the channel. In this video, we are diving deep into an essential concept for every trader, and that is the implied volatility trading strategy. If you've ever wondered how market movements can be predicted or how traders identify potential breakout points, then you are in the right place. Understanding implied volatility can significantly enhance your trading decisions, helping you spot opportunities and manage risks more effectively. Now, before we dive into the details, don't forget to hit that like button and subscribe to stay updated on more trading strategies, tips, and insights. Now, let us get into it. What is implied volatility? First things first, let us define implied volatility and why it is so important for traders. Implied volatility refers to the market's expectation of future volatility in the price of an asset, such as stocks or Forex pairs, based on the prices of options contracts. It's important because it gives traders a sense of how much the market thinks the price will fluctuate in the near future. Essentially, implied volatility is the market's forecast of future price movement expressed as a percentage. The higher the implied volatility, the greater the expected fluctuations in price. Lower volatility means the market anticipates smaller price moves. Now, the cool part about IV, IV is short for implied volatility. The cool part about IV is that it's forward looking, which means it's a crucial tool when you are planning your trades. But here's the kicker: implied volatility does not tell you the direction of the price. Okay? Implied volatility does not tell you the direction of the price movement, just how much the market expects prices to move. Okay? This is where implied volatility trading strategy comes into play. All right? Now that we understand implied volatility, how do we integrate it into our trading strategy? Well, there are a few ways you can use IV to your advantage. The first is implied volatility spikes. All right, a sharp increase in implied volatility can signal that a big move is coming. This can help you prepare for significant market changes, whether the market is moving up or down. By tracking changes in IV, you can spot market shifts before they happen, allowing you to adjust your strategy accordingly. Secondly, can help you determine optimal entry and exit points. Okay, high implied volatility typically indicates a potential for a breakout. All right. Now, can see what happened around here. I just added two implied volatility related indicators, just for additional insight. Okay. So if implied volatility decreases, on the other hand, you might look to exit your trades before volatility dies down and prices stabilize. Also, talking about volatility contraction for breakout trading, implied volatility tends to contract after big price movements or during periods of consolidation. When volatility contracts, the market often prepares for a breakout. By monitoring IV contraction, traders can identify when a breakout is likely to occur. This is especially useful for those who follow breakout strategies. Now, one thing to note is how implied volatility affects the pricing of options. Okay, IV is a key component in determining the value of an option. Higher IV means higher premiums, and lower IV means cheaper options. If you are a trader who uses options, understanding the relationship between IV and option prices will help you identify the best opportunities for entering trades. In Forex, while we don't deal with options directly, the concept of implied volatility still affects how we analyze currency pairs. High IV can indicate that the currency pair is more likely to experience large price moves in the near future, so you can adjust your trades accordingly. Okay? Managing risk is always a critical part of any trading strategy, and implied volatility can help with that too. If you know that implied volatility is increasing, it might be wise to adjust your position size or set tighter stop loss orders. Similarly, during periods of low IV, you may opt for wider stop losses because the market is likely to be more stable. Now, implied volatility can help you understand market sentiment. For example, if IV is rising, if IV is rising but prices are not moving much, this could indicate that traders are bracing for a potential market event such as an earning report, economic release, or geopolitical development. Speaking of market events, it's important to understand how events impact implied volatility. Earnings reports, central bank meetings, and even geopolitical events like elections or natural disasters can send IV soaring. Traders often prepare for these events by monitoring the implied volatility levels, knowing that the market may see a significant move once the event occurs. By tracking these periods of heightened IV, you can make strategic decisions about whether to enter a trade, stay out, or adjust your risk levels. Okay, let us summarize what we've learned in this video. All right. Implied volatility reflects the market's expectations of future price movement. If traders anticipate whether big price swings are coming, okay, it helps traders actually anticipate whether big price swings are coming. You can use implied volatility to time entries and exits by monitoring volatility spikes and contractions. For options traders, IV directly affects the price of options, while in Forex, it provides insight into future price movements. Implied volatility also plays a crucial role in risk management. Higher IV suggests larger price swings, so adjust your risk accordingly. Market events such as earnings reports or central bank decisions can increase implied volatility, providing opportunities for traders who can spot these changes. If you found this video helpful, don't forget to like and subscribe to the channel. Stay tuned for more content on trading strategies, tips, and techniques to help you become a smarter trader. Thank you for watching, and I'll see you in the next one. If you have any questions or comments, feel free to drop them in the comment section below. And as always, happy trading.